Where are you?
I'm good. A little frustrated like everybody else.
What did you do? Frustrated?
Just frustrating. You get profits, and if you don't take them, then they're gone in a minute. So
yeah,
because
that's what I was just looking at, the 30-year. I'm still short 30-year. I rolled in June, and yeah, I missed my out by 10 ticks. 155.05 in the June. I think we went down to 27. I didn't cover.
27. So, but it's just everything moving, and it's pegged to the long end, which again, yeah, Powell was absolutely. He's either the smartest man in the universe, is very Machiavellian and letting the markets do what he would like to do, but the Fed board wouldn't, or he has no clue. I'm really I want to cut him the benefit of the doubt on everything, but I'm very skeptical. I thought yesterday's performance, who said it best? Somebody said it very well. Peter Bookvar. Peter Bookvar said it. He was quoting that line from from Hamilton, which was "Smile more and say less." Because I'm telling you, I don't know. Yesterday was really to me unnerving, but I've been on this, and he is in a war. And again, I guess you're not in a war if you don't acknowledge you're at war. So,
hey, Ira, can you go on camera real quick?
Yeah.
Everyone always likes when we do that.
Oh, okay, sure. Yeah, no problem. So I mean, there was no surprises. His language was more than a little disconcerting. And again, I guess I'll get to a break point. Where's that break point? I don't know. Was today's unemployment number important? There was good and bad in it, as there is every one of them. Of course, the good part is that the jobs in hospitality, meaning hotels, restaurants, airlines, those were coming back, and that's a good thing because that affects, of course, the people who supposedly the Fed is trying to help most. So I think, we saw some of the beneficial aspects of that, but it still leaves us in this quandary. And why he's in a war. There was a piece in the FT yesterday about how some of my favorite people, I view myself in that group, but nowhere near to the level. Analytically, yes. Trading wise, no, because I wouldn't be retired. I'm not the retiring guy, but I don't know what I would be set up differently. But you look at Kovner, the big macro guys, Brevin Howard, so they had massive months because they're short the long end of the debt market. They had February, they had big months. It was a really good FT article. Really caught my attention because it says who's attacking them. This is who's attacking them. And they're attacking, as the article made clear, all over the world. They're going after the Japanese bond market. They're going after the Australian. They're going after the Kiwi. They're going after the Brits. They're going after Canada. They're going after everybody. Now, they're going after Europe, but I think Europe is a different animal, by the way, because I think that they are involved with they're already doing yield curve control. And the reason I say that is because they buy on the long end, and they've got 19 variables to choose from. And yes, I know this is a very technical measure, they have to hold to the capital key, but Draghi had already said, we don't look at the flows on a daily basis, meaning by what they buy. They will adhere to the capital key over time. What market situations may render that to the back seat, so to speak, as they have to intervene, maybe to shore up the Italians one day, the Spanish one, they have that flexibility. So to me, they're already imbibing, if I could say it like that, in yield curve control, which is why it's much harder to attack the European bond market, because the ECB does not disclose how they're going to do this, and it keeps everybody off balance. So with that, I ran some charts this morning, and we have the U.S.-German. I'm going to leave you for 1 minute so I can go hunt this down. Let me go get it. I have to print it, so I have it in front of me. Sorry, right there. So I went and I looked. I haven't completed this work yet, but I am looking at it. So if you look at the differential on the German US 10-year, which I think is a very good measure, the yield is out to the widest it's been since last year at the start of the pandemic. It's 186 basis points differential. Now, the last time we were out, and this is an important measure for me, the last time we were this wide, which was basically last February, the euro was trading around 110. So now I have some perspective as to where we're at. So can we go back there? Yes, but it'll be interesting to see if these yields stay wide if we don't, and if the dollar starts down again. So that's what I'm looking at. I'm early on this, but I'm just trying to give myself perspective on where we're at and how this could possibly unwind itself. Now, when I listened to Powell yesterday, and again, he's going to have to go to yield curve control. I just don't think the other way around it. Especially, and we talked about this the other day, especially if they don't want the dollar going higher, the best avenue is to go yield curve control, because then you'll let the market do it for you. And if you went to yield curve control, he would actually be acting against the people who are at war with him by continually selling the
Banks.
The bond market, and he would force them to capitulate and he would force yield long-term rates down, and they would be the ones who would be doing it, because they would be forced in a position where you can only fight the Fed as long as you know that they're not playing there. Once the Fed says, "Oh, we're going to do yield curve control," there's not going to be a lot of money to be made. Yeah, you can keep coming at them, but if the Fed says, we're going to buy 100 billion, that's a tough thing to sell. And how do we know the shorts? We got confirmation, by the way, about how short this market is, not just in the futures, but in the cash as well, because the fails on the 10-year repo market were great, meaning that people are not surrendering. So if you've borrowed 10 years in order to be short the market, you're not letting them go. You need them, because in the cash market, to be short, you have to borrow the assets, just like with the stocks. When you're short stocks, you have to borrow. That's why we see certain things like GameStop. Why did that take place? Because everybody was short, and there was no stock to borrow, so you had to cover your shorts. So it was a big problem for the short players.
The 10-year was negative on the repos last night, weren't they?
Negative 4%. If you have a fail, you have to pay a 3%. Now that's an annualized 3% rate, by the way. So you can pare it out, but it's still costing you. But if you're willing to pay that, it tells you the short position is making you more money. You're willing to pay it away, and you're not willing to surrender it because you're afraid that there's not enough tenure and you won't be able to borrow it back.
Yeah, okay.
It's a pretty good indication. And the Fed has to be attentive to this. He's sleepwalking. Or again, he's the most brilliant Machiavellian guy going, hey, I want this, but it's actually not a good thing from another perspective. And again, we talked about this today, because now you have Yellen and Sherrod Brown talking about ending the relief on the supplementary leverage ratio. Now, if in fact they move to do that, now it's really a Fed regulatory, but the Congress has oversight about it. But if they will not extend that relief, then it's going to be even more important for them to go to yield curve control because the banks aren't going to be able to buy the long and warehouse. We talked about this the other day. So it makes it even more critical. So he is either an idiot or brilliant because he wants to test everybody's mettle. And I'm caught between it because, I want to give him the benefit of the doubt. But after I listened to him yesterday, I was pretty nervous. I said, no. And the market, the unbelievable thing is the market was pegged, had he even mentioned it, to go higher, because if you look at 1105, run a gamut of 5-minute bar charts, okay? Run the smooths. He started speaking at 1105 Chicago time. The high in the S&P was 1105 bar. The high in the notes basically was on 1105 bar. The low in the dollar was the 1105 bar. Hold on one second.
That's a crazy look. Yeah, Steve, I got your question. I'm going to ask him. Oh my God, I wish I didn't get stopped out. I got stopped out and I didn't put him back on. And again, like we were saying earlier, it's been a good week. I got ticked out, man. Ticked to the tick. Look, in this noisy, all of us in this noisy trade that we've got, just stick with our targets. Stick level to level. Can't hear you.
Okay, now I know I had Josh. I had to take
Hey, real quick, Ira, I got Steve Furch, who was an order filler in the 5-year for years at the Board of Trade, and asked a question. He sent me a question a minute ago. And for him to ask it's important because this is a guy that understands the details of velocity logic stops and all of that stuff.
Wait a minute. He was the only guy in the 5-year who understood it, but
he may have been, yeah.
Sorry, Steve.
So he wrote, what are the mechanics, or his question is, what are the mechanics of the yield? What would be the mechanics of yield curve control?
Okay.
How's it look? And I've got an idea, but that's a great question.
Yes, it is, Steve. And I hope you were filling for one of the greatest guys who I know, Gary Sagui, who's like one of my heroes. I actually communicate with Gary. He was a great, he ran that curve I don't know, when he was doing it from the 30s to the 10s, 5s to the 2s. I mean, nobody was better at it. Sagui was just great. And he's a guy who I love to talk with. Really, just a brilliant guy. But here's the way it would work, as I see it. And you can call it Operation Twist, as some are, but that's going back to, of course, the history of the Fed, and we're going back to 46 to 51. And I would beg you to go look up what Alan Meltzer, who has written a 2-volume book of the history of the Federal Reserve, which is great. But Meltzer covers it. There's a chapter or two on it from 46 to 51. And here's what they would do. So instead, where they do all their buying, Steve, because duration is about 80% of their portfolio, the Fed's balance sheet, is 5 years or less. 80%. That's 80% of 7.5 trillion, because that's where they do their buying, which is why there's a lot of problem in the repo market, because they've hoovered up. Oh, God, I hate that word. They have sucked up so much of that volume. That's what's sending repo rates lower, and overnight funding rates for the swap market, because there's just not enough paper, which is why there's so much activity now in the 10-year using it for the swap. So they would actually start selling out some of their portfolio and using those proceeds to buy 10 years and out. So they would be extending their duration, which would move to crush the yields on the longer end, where people now have a free ride because they know they're really not playing there. Yes, they buy mortgage-backed securities, and we know the mortgage-backed security market has been held artificially low, which, by the way, has bid up housing prices, which is, again, a way in which the Fed policy is failing, because they're in favor of helping everybody, and yet they're bidding housing way away from the middle class that that they are pretending to help, because they've held rates so low that there are people who buy and can reach for a higher price or push housing prices higher, because the cost of financing it is so much less. And there are people who would be crying the Fed should step out of the mortgage-backed security and actually take that $4 billion a month that they buy, because they buy 80 billion of treasuries and 40 billion of mortgage-backed, and use it to buy the treasury up. That would operate in the same way, because it would push treasury yields down rather than buying mortgage-backed securities. That there's no reason in the world to buy mortgage-backed securities now. That they're supporting a market that doesn't need support and is just bidding it to levels that are destroying the signaling mechanism. So that's the way it would work. How much? First, they're going to jawbone it. They'll come out and say, well, we're really thinking, because we see the impacts of it, and we're thinking about it. You got a Fed meeting next week, so we'll hear a little bit more from them, maybe. But I will tell you. So, Steve, tell me if that's okay, what I said. If you need more, we'll talk more. But
Steve, can you unmute? There you go.
Thank you, Ira. I assumed it was going to be something like Twist, where they were going to adjust the duration.
Yeah.
I wasn't clear on who's actually calling for it. It seems like the dealers are, the short end may not be functioning as well as it could, and so that there's some impetus on the banks. They want. It seems like they want. There might be some structural issues they're trying to address there, but clearly, I didn't know that 80% is, obviously the mean duration you said is right around 5 years. That's crazy, right? I mean,
you can go.
They're completely locking up that market.
They post it every day at the Fed website, so I'm pretty sure that number is right, because I haven't checked it in a while, but it's been there for so long, and you go, well, why would you do this? And especially, and an issue becomes if Lizzie Warren and Sherrod Brown have their way, and March 31st, that relief mechanism on supplementary leverage ratio ends, that's going to put more and more pressure on the Fed. And you're right, the dealers would like it, because I'll tell you what, they got smoked on that 5-year on the last auction, because that 5-year went off at 62 basis points, which was a miserable auction. And by within 48 hours, 36 hours, it was trading up at 82 and 83. And that they, having taken down 27%, that they were stuck with more inventory than they would want. So they would like some relief here too, because of course the Fed utilizes them so much to affect the policies that they're trying to do, and yet they're taking it on the chin at times. Of course, the banks, would like the voter rule rolled back, and that's not going to happen. Not with who's in power now. But this is an important element for me to watch here. Watch Janet Yellen, because the last time we did Operation Twist, and I'll tell you who else is calling for it. Two of my favorites, Mark Cabana at Bank America, and of course, Credit Suisse, Zoltan Rozar, they're calling for it because they think it'll relieve some of this pressure and give it a more definitive outlook to the Fed as to what they really want to do here. The Fed wants a free ride here, and the market, thank God, because Steve, I know you, everybody who's listening here, I respect what markets signal, and the market is saying, hey, you're giving us a free ride. We're telling you how you're trapped here. How are you going to respond to it? There's really no way out of the trap anyway, but how high will you let this, well, how far will you let this curve steepen is number one. And number two is, of course, how far will you let rates rally or rally? They're not rallying. How far will you let rates rise before you really get concerned? And I say to watch Yellen because it's the Treasury who has to finance this. And the politics of financing as the yields rise is very important because that's what's going to cut into all types of discretionary programs potentially. And the political optics of that are causing a lot of people a lot of nervousness. And that's what Yellen has to be concerned about. So I'm watching her. I think she's a linchpin to this.
A linchpin.
Thank you, Ira. Very clear, very interesting too. The aspect of watching how Janet Yellen is watching, for signals from her. Very interesting.
Well, and I say that, Steve, because I think she has much more of a presence on the global scale than Jerome Powell does, by the way, because her voice carries a lot of authority. She was really respected. I mean, you think about that, Donald Trump truly thought about reappointing her. And he kept asking that question. And I have to say, I was asking the same question yesterday. Who is this guy, Jerome? I hated having to be in bed and agree with Donald, but when I watched him, and she can ride roughshod over him. He's not going to like it, but she has a lot of the bully pulpit, and it's going to fall upon the Treasury as to how this works out. As the same thing that took place in 46 to 51, by the way, because you had massive government deficits, of course, to fight World War II and all the Lend-Lease programs, and then, of course, the Marshall Plan. And there was a lot of debt that needed funding, and the Treasury was concerned that with inflation soaring, which it did, because of pent-up demand consumer demand coming after World War II, where people, I know my dad's stories. When he came home, he had all this money saved up. He used to send it home to my mother. My dad was a very good poker player, and he was sending home all the winnings regularly on top of it. But he had a lot of money because as a soldier, he didn't, there wasn't much to spend. The Army was providing you with everything. So he had all this money. So he was actually a street smart guy. He grew up on the streets, 8 kids, a 2-bedroom apartment. Believe me, the depth of poverty. But he said, what's everybody going to want? He said, automobiles. So he went into the used car business because there were no new cars. So he would go out all over the countryside looking for automobiles because he said that's what people were going to want. So I know those stories, and there was huge inflation. And yet interest rates were, real yields were held artificially low, which is what Carmen Reinhardt's work on the financial repression of that, by the monetary and fiscal authorities in that period was done intentionally. And people, if you owned bonds, you were getting killed, but you did it, there was a patriotic endeavor to it. They have to, and it was really the Treasury. So I'm watching Yellen here. I think I'm waiting for her to become a little more verbal. She's being very respectful up to a point, but the Treasury has to be concerned about where yields are at.
Yeah, as you mentioned, I agree with you 100%. The politics of debt going to come into play, and that's going to land the ball in her court. And thank you. By the way, I do know Gary and Matt, and you're right. They great gentlemen and extremely good at what they did. Very good. Made great markets. Stand-up guys. Really,
absolutely. You're 100% right. I couldn't say enough really wonderful things about him. Him and I did a lot of work together when I was on the CME board back in the late 90s and early aughts. and Gary and I actually worked out with Tex. You know, he had a rocket scientist who
Yeah.
did a lot of the high math. Tex, who was an unbelievable, brilliant guy.
Yep.
And we had actually worked out. Gary and I sat, because Scott Gordon, who was chairman of the CME at the time, and we wanted to figure out how to do common clearing, because Gary figured out, and he was a huge beneficiary of it, but so what? You know, that was the way it was working for everybody, all the clients, how to reduce capital costs by about 35% by common clearing. And we had it done. We had done a lot of work on it, mostly Gary, and I had it sold at the CME, and he thought he had it done at the Board of Trade. And of course, the Board of Trade at the last minute, the old line clearinghouse guys pulled the plug on it. And I told Scott, I said, don't send me over there anymore. You get all these things done, and then the established powers say, no, this may especially because the Board of Trade Clearing Corp was not owned by the Board of Trade.
That was the kicker there, wasn't it?
Yep. Yeah, absolutely. And it was a grave mistake, by the way.
Yes.
And the Board of Trade they got bought out by the CME, but had that done, I think you would have seen a merger done at a much lower cost to the much greater benefit of everybody else, which we knew. And then, of course, Steve, you won't like this, but we were trying to put the headphones in to placate everybody from the back month euro dollars into the treasury markets, and to counteract really Cantor Fitzgerald, because we knew that we could undermine them and we would make that arbitrage, which would have benefited you, Steve, as an order filler. But at first you would have probably gotten a little hit if guys who were in the pit were wearing headphones and could do it directly. And I knew that was a sore point, but we were going to run it as a pilot program. And then Gary and I had a full buy-in on that from everybody until that frigging committee of the old line pulled the plug. And that was very short-sighted. So they killed those two deals, but we knew where we were going, because we would have been the powerhouse that would have driven the New York money market guys absolutely insane.
Interesting. Behind the scenes view from IRA. Great.
You can have, Gary and I had long conversations about, we were none too happy.
Really, what were they trying? What was the attempt? Was the attempt to prolong business on the floor by the Board of Trade, trying to isolate themselves and to remain in control, or or the prestige?
Yes, they were afraid they were going to lose control in the way that they had always had it. And the clearinghouses, were very conservative, and they thought they could go it alone, but it had definitely shifted. And the CME had a recent, he became the president, Fred Arditi, who was one of the most brilliant people I've ever met in my life. And I spent many hours with Fred, who's just, his passing at too young an age, but Fred was brilliant. And we had really figured out through a project called Liberty, in which we could do the whole complex through the Board of Trade and the CME futures pits, and really put a big hole in the New York market, because we had much greater transparency. The market, I would still argue, isn't transparent enough. They talk about the electronic venue of it, but it's, it was the Board of Trade who put transparency, and it was the Merck Eurodollar and T-bill contracts back in the late 70s, early 80s that really put some transparency, just like it did in the currency markets. And if there's one thing Wall Street hated, was transparency, because the ability to price those things behind the screen, rather than allowing people to see it, protected a lot of their profits. So one of those things that drove me absolutely insane for a number of years. So.
When I reconnected with Sturch a couple of weeks ago, we had he had come into our group and had a conversation in Discord about when he had started at the Merck, and it was still the Merck was kind of dying. It was onions and eggs. That was it.
Yeah.
Then bellies came, and then the currencies. What do you what can you point to, Ira? And I know this is off topic, but still, it's interesting to me. What can you point to in the progression from the 60s going into the 70s that changed that began the gradual change not, yeah, that's a way to put it, that gradually changed the prestige of the exchanges, and with the rise of the CME and and all of it, just all of it.
I'll give you a quick historical perspective because I know this will bore people. So Bretton Woods ends 71, August of 1971, and Leo Malamed, with a few others, but especially Leo, had the foresight to say, well, currencies are going to start moving. They're unhinged now. So he went to Milton Friedman. Milton Friedman wrote the paper. They were able to go to Congress, with Milton Friedman's imprimatur. In fact, just had dinner with Leo the other night. We were talking about it because George Shultz who just passed away, was and Leo has a book coming out. I'm preempting the book, which will detail the complete history of it. And George Shultz said, well, Milton's behind it, being both University of Chicago people, and George Shultz was an economist out of the University of Chicago, but he was Secretary of Treasury and had a big presence, chief of staff, and so if he says if Milton's in favor, we're in favor. So that got the currency approval to list foreign currency contracts, and a lot of people laughed at it. But at the same time, also the Board of Trade was working on, a little bit later, with Doc Sandor, who's one of my favorites. I still talk to Richard.
Brilliant.
Put together the bond contract. CME developed the T-bill contract. So you now had a focus on things. And then, of course, gold finally becomes tradable. So everybody rushed to get a gold contract, which helped elevate things, which was good. And so you have all of that in place. And that lifted it off because you weren't going to build it on bellies, hogs, and cattle. That was not going to take place. And the CME, by shining a light, and it was like perfect time. And I'm spoiled because here I was in graduate school. I graduated in May of 75. Started graduate school in August of 75, and my work was done. I had hoped to get a doctorate in international relations, but my work really became involved on studying the political aspects of multinational corporations and their power in the world market and why. And I wound up learning, because I had great professors who really dug at me. So I learned about the debt and foreign exchange markets, and it was perfect because Bretton Woods and everything. So actually, Lonnie Feldman, my dear mentor, who was a friend of my dad's, had called me at school, and Lenny and I are always very close. He asked me once about, he came to see me play football, and he asked what the line was, of course, because he'd bet on anything. I mean, nuts, but of course he was nuts in a great way. So Lenny says, your dad tells me you know a lot about foreign exchange. I'm starting to trade currencies at the CME. He was a cattle trader, but he he started subscribing to certain letters and reading. He says, I'm just beginning to trade currencies. And the German elections, it was in 76. He says, tell me how it's going to affect the Deutschmark. So I wrote him a 3-page paper and sent it to him. And it was absolutely dead on target. And he said, hey, so when I left school, because I knew I wasn't going to get a doctorate, so I said, I'm out of here. So he kept calling me. I was reffing high school basketball games in 77. And he kept saying, come on, I'm doing this currency arbitrage. You know more about it than anybody I know. You're perfect. And I kept saying, no, I'm not going down there. I hate the place. I'm going to Washington, because I had lined up a job with the church subcommittee on multinationals. And then that disbanded. And when he said, well, you still want to go to Washington? I said, I'm not going down there. So he called me a third time and says, I'm not going to ask you again. So my parents said, take the job. Oh, I'd also interviewed at banks, because I told my parents, well, I'm leaving school. And I'm coming home. And they said, well, they sent me $250 to buy a suit. And my hair was bare. I mean, they said, you're going to get cleaned up. You're going to work. I said, so I bought a suit. I can tell you where I bought it. It's right on State Street in I was going to school in Madison, Wisconsin. Of course, what did I know? I bought a brown suit. And I went to interview. I was interviewed by Continental, First Chicago, Harris Bank. No, not Harris. I didn't go to Harris, but I went to American National. And they said, well, what can you, why you don't have an MBA? That's the first thing I heard. I said, well, yeah, but I can analyze your what was called third world loan portfolios at the time. And I told them how they were going to blow up. And they laughed at me. They said, these are the best lending that we're doing. You have no idea what you're talking about. And of course, those loans destroyed Continental. And I did get my it's not revenge. When I heard that Continental was on the rocks because of some of the lending, is of course through that bank down in Oklahoma. They had real exposure. So I actually put on what were known as TED spreads, where I was long T-bills and short intervals. And it was, and I went to the golf course, so I wouldn't screw with them. And it was a big position, and I just let it run. Probably the single best trade, because I didn't overtrade it. And it, a lot of money for me in those days. I mean, it wasn't it was a big position for me at the time. And I said, okay, I guess I was, so that was very self-satisfying, because it really put me to understanding that the things that I had learned through some of the really greatest professors you can imagine, they really taught me a lot. They taught me a lot about currencies and a lot about debt on a global scale. And that's how I got to this. That's it in a nutshell. And the world couldn't have been better timed for me. I get up in the morning, I thank God every day for the opportunities and the wisdom that he was able to provide for me. I mean, I was arduous, people today will say to me, even I have a good friend, Kevin McCarthy, we were in graduate school together, and I left the year before him. He sat for his orals, and I said, why are you going to do that? He says, well, this is what I want to do. He was working on the Soviet Union. That was his expertise. And then he calls me, he says, hey, can you give me a job? I got him a job at Madoff running their currency arbitrage, because he was very, and we talk every day still. And he'll go, I can't believe the crap you remember. I said, yeah, I know.
Hey, Ira, I have to say, your historical perspective is unbelievable. Your memory is, holy cow. Just, what I want to say is it adds a lot of context to the group, because one thing we know, if you're in markets long enough and you study markets, they're going to repeat, and it may be a slightly different skew, but in general, when you scratch through the surface, it's the same. And I just wanted to thank you for that, and just you're an amazing intellect and a real blessing to the group. So thank you.
Thank you, and it's really nice to hear. And as Matt has said, it's nuance and context, Steve. So you make the point, because it does repeat itself to a certain way, but there's always a little kicker in there that makes it different. And that's where the real money is to be made, is understanding where that difference is. And that's the nuance of it. It's never the same. It'll appear the same to the eye, and then all of a sudden you dig a little bit. Oh, this is, and to me, that's what makes the guys like Druckenmiller. They are able to see that and operate that. Right now, exactly what they're doing, because they're going, hey, I have a free run here. And they're taking the free run. And I don't think that the Fed, because they're academically oriented, want to see everything through that fine, that it's just repetitive. Oh, our models are picking this up, but the models don't pick up the nuance. But they don't know how to build it into it. So they have, and they get all academics. The history of academics is that they all love to get married to their models, just like, there are people who get married to stocks because they love the concept, but then you dig deep enough and you go, oh, there's really nothing here. And yet they built the company and they can't admit it because that's all they have. And that's what academics have. They're married to their models. And I don't care whether you're in political science, especially the social sciences, you spend your time, you have, bias outcome because you're biased that your models have to work. And that's where we find the opportunities to trade against it and make money. Yeah, that's really it in a nutshell. So those words are very kind, and it's really kind of what I strive for. That's what my work is about. So thank you.
It's very interesting. I do have one question, and this is something that's kind of perplexed me for some time. With the expansion of the balance sheet, like when someone says normal balance sheet, I have no idea what a normal balance sheet, nor does and my colleagues will argue that, Steve, why does it matter? The Fed is going to continue to expand the balance sheet, perhaps ad infinitum, and it just doesn't matter. And I keep thinking the chicken has to come home to roost, and I can't envision what that might look like or how that might be. And it's one of those things that I shouldn't be wasting my time on, because it is what it is to a certain extent. But you have any thoughts on a normal balance sheet?
Wait, hold on. I don't know well, we know what normal is. It's on a percentage basis of, how do we want to measure it? GDP? So what's the size of, and whose balance sheet? Because we also have a problem with the Treasury's balance sheet, which is called the Treasury's general account, which is in play here, because where that used to run about 150 billion, which is what they would keep just to have enough money to meet short-term payments. It exploded as the Fed Treasury was issuing T-bills recently, and to build up a reserve of $1.6 trillion. So that's what they're talking about running down. So as that is released into because they have to run it down. And that's what's created some of the havoc in the short-term repo market, because they know this. And that means that as that cash makes its way, there's going to be a shortage of T-bills. Why? Because people who receive, when it becomes reserves, the banks are going to have to go and purchase short-term T-bills, or whoever else needs the money. So they're a little worried about that. That's why they've been trying to get out in front of that. As far as what the Fed's balance sheet looks like, I mean, you can go back in time. Maybe it was 300 billion, which was probably high, 400 billion. Now we're up to 7.5 trillion. Well, because and all of it, and then people say, well, where's the inflation? That's the battle cry from the Steve Leisman crowd, whenever they want to beat on Santelli and others. Well, there's been no inflation. Well, two things happened in 08 and 09. Number one, Congress gave the Federal Reserve authority to pay interest on excess reserves. That's a very important number, IOER, because when, the reserves at the Fed were never, and that's what we're talking about, were never that high. And if you were in a bank and left overnight deposits, you didn't get paid interest on them, even when interest rates were 4, 5, 6%. Well, they knew they were going to be creating a lot of reserves. And if they needed the banks to partake in this, the Fed was given the ability to pay interest on the overnight reserves. So if the Fed funds rate was 175, they were paying 150 basis points. Okay? Always less than the Fed funds rate, but there was an arbitrage in there that people played with. And the Fed could raise them. They could actually pay above it, but that means that there'd be no money flowing in the system. It would all be parked at the Fed. That's why those velocity numbers were so ugly for so many years, because banks were just parking. Not anybody can park reserves. Now, I'm going to give you a little history lesson here. And this is very important, by the way. There was somebody who came out of the Federal Reserve, I forget his name, who back in, who saw this and was going to create what was called the narrow bank, NARROW, the narrow bank. And the sole function of the bank was to take deposits from big institutions. They thought that they'd be able to get 200 to 300 billion in deposits and pay them about 15 basis points less than what the interest on excess reserves was. Okay, so the interest on excess reserves was 150 basis points. They would pay 135 to their depositors, and they would put it on, they would get the okay to put it, so they would glom basically 15 basis points in a healthy market. Well, 15 basis points at the end of the year on 2 or 3 or 400 billion is a lot of money. The Fed wouldn't give them approval. They're still fighting this in court, by the way, because that would have blown up the entire Fed system, and they knew it. This guy came out of the Fed, the New York Fed, by the way, and he saw the window of opportunity, and he was, and they blocked it. They're still blocking it, and now it'd be harder to do because I think interest on excess reserves right now, I think they may have just raised it to 10 basis points because the Fed funds is between. Well, here I can give you exactly what it is. So I'm looking at the April Fed funds. 7 basis points is the future contract on the April. So I think interest on excess reserves is 5 basis points. So there's really not much there on the bone, but they keep it below because they need somebody flowing through the system. Otherwise, everybody who had excess reserves would just park it at the Fed. So that's a big part of that story. Again, it's one of the nuances that exists, and they're afraid. See, if they cancel this, they're afraid that all those excess reserves would start to flow out into the system, and then you would get the inflation numbers because even though modern monetary theory has taken a back seat to many other things, they're afraid that if that money started really circulating in the system, that you would get significant inflation, which would really blow up the Fed's plans. So all of this is in play. By the way, these are all very important things, and how it all comes to an end. This is what the Fed has created. They really have no exit strategy. That's the problem. They've never had an exit. They thought they had an exit strategy. In fact, Ben Bernanke used to talk about it in 2012, that they would just let all this debt expire and roll off and they wouldn't have to worry about it. Well, we know that that's not the case because they've kept renewing it. Because if they let it roll off, that was deemed to be the taper tantrum. If the Fed was shrinking its balance sheet, there'd be less liquidity in the system and the market got very nervous. So the Fed has never revisited it. It's really May or June. Well, they did. Powell, remember, started shrinking the balance sheet in 2018 and raising interest rates at the same time. And Santelli and I, July 10th, 2018, I did a Santelli and I said, you can do one or the other. You can't do both simultaneously because we've never been here before and we're not going to know how this ends. And of course, by the fourth quarter of 2018, Powell gets very nervous. You get the pivot in January. And Druckenmiller famously said in that interview in December, it was the double shotgun approach had created all this monster havoc. And that's, again, they don't have a real strategy, but they're scared because everything they try when the market drags on it, they're left in a situation, which is why they should be proactive on the yield curve and get out ahead of it. Because when you're reactive, the cost is far more than you can imagine. It's better to be out in front of it.
Last question, Ira.
Yep.
And again, it's from my overly active, negatively influenced brain. Is there any prospect or have you ever thought about the concept of a failed auction?
Oh yeah, I think we got close to them with the 5 and 7 last week. Because let's face it, the 5 is a joke. I know why it's there. It's where the Fed plays there, so they keep the yield suppressed. But at last Wednesday's auction, a week ago Wednesday, when it was 62 basis points. Well, the Fed says that inflation is using the PCE is at 1.65, 1.7, and the 5-year is a capital instrument, so you're clipping coupons, and you're getting 62 basis points. Well, you're operating at a negative real yield, and I'm using the Fed's numbers of 110 basis points. Well, who the hell would want to own that? Okay, at least if I'm forced to buy a 1-year T-bill, I know, and I'm doing it for safety and comfort because it's better than getting nothing, right? If I go to a bank and I buy a 1-year CD, how much am I getting? Very little, so to speak. So okay, I'll buy the protection of the federal, of the US government, but why would I do that for a 5-year? And I understand the importance of high quality liquid assets for repo, but I can stay at 2 years. So the 5-year to me has been a joke, because ultimately, if you really want to look at the history of money as we understand it, high quality performance by the central bank runs a real yield of about 1.5% historically. 1.5%. 1.5% of real yield. So if GDP was 3%, the yield on the 10-year would historically been about 4.5%, because you needed to pay people to buy your bonds. And now Larry Summers and others would say, well, that's blown apart because you have a surplus of savings. Yeah, I've never bought into that. Yeah, it's a nice discussion, but if the economy's running healthy, we all learned the equation in Econ 101. So I don't go there. I don't, because there's enough investable opportunities around the world that, yeah, for short periods of time, you may have an excess of savings, but then interest rates drop and people stop, and then they look for investable opportunities outside of that. Now you can say, well, Larry Summers would call that secular stagnation, but the jury is still way out on that. So I'm not in that camp. I just think that there's been an effort to repress savers, financially repress savers, by pushing rates into negative territory, forcing you to spend money. But of course, people get nervous and they're not spending money for various reasons. Or, high taxes coming. These are all part of economic historians' toolbox with retarding equivalents. I mean, we've seen this. So I'm not there, and I'm not going there, and I won't be there. So it's all kinds of stuff to be measured here. But I think the Fed has really trapped themselves. They don't know how to get themselves out. This forward guidance, which is from the academic work of Michael Woodford, I think it paints them into corners that they have great difficulty in escaping. And when the market, right now there's a red line that they, supposedly painted with the lower for longer, but they're not partaking because, again, they're not buying where the traders are going to play, and that's putting pressure on them by selling the long end of the market, taunting them. They're taunting them, and yet, okay, it's like I say, the famous short story from Herman Melville, Bartleby the Scrivener, where he continually says, "I choose not to." They don't want to play. Well, you know what? The markets go, okay, you don't want to play? Fine. But eventually you will get to a break point. You will eventually get to a break point. I don't know what it is. I don't know what it is time, and I don't know what it is price. But there will be a break point. And that's why I come back to I'm watching Yellen.
Thank you, Ira. Thanks again. Great discussion.
Hey, great question, Steve. And I hope you had the opportunity to fill out of my orders when I used to trade. I still own 2 AM seats, by the way. I bought them before the merger as a cheap way to get some CME stock.
Yeah.
I used to yell at Charlie Carey going, you're assessing me? I have to pay that $1,000. I'm not earning that much on the damn seat. I wrote him a letter once. I had to apologize so many times. It was swearing at him. And Charlie and I, really, I had many fine dinners with him. We discussed. He was another guy with Sagwe trying to get the changes, and then when he became chairman, it happened, but it took him sitting in that seat. So
Charlie's an interesting guy. I got to know him a little bit when we had that fundraiser in 08 for McCain. I asked Terry, Terry kind of, asked me, they exchanged back Hillary or endorsed Hillary in that. And I think it had something to do with the Senate hearings on the antitrust. But whatever it was. I'm sure you know. Yeah, a little bit, Mark. But so I asked Terry Duffy, or he asked me, it was a conversation about, wink, wink, nod, nod, go ahead, please. Terry and I had brought a bunch of fundraisers together, and he had, can you do something for McCain? Just, we can't have anything officially to do with it.
Yeah.
So, we ended up, me and Brian McCormick from the Yard ended up putting together a fundraiser for him, and it worked. But we were struggling. We had to promise him $250,000. So Brian and I had to put up that money to get him here, to get and Lieberman here, if you remember. Yep. And then Charlie came on. Charlie said, "Okay, I'll put my name on the invitation." At that point, Jack did, Leo did, Terry did, and we raised like $700,000.
Yeah. Yeah. You may as well throw it in a can and burned it up. Oh. Yeah. I'd like that 20,000 of my own money back for that. Okay. So I'm going to leave this soon, but let me give you some perspective issues here. Because I believe in markets being mean reverting. They get way overextended, and it doesn't change the underlying fundamental dynamic of it when they revert to mean. So 1, 2, 3, 4. Now this is my world. I'm not even talking about equities, and I know a lot of people trading equities, although they're getting hammered as we speak. So I went, and it's really interesting after these last 6-7 weeks of really high volatility. We have these. So the platinum gold, which I've looked at quite a bit, is at the 200 week. The silver copper is at the 200 week. The CAD Swiss, which is one of my favorite crosses to trade, is at the 200 week. The euro yen is at the 200 week. The euro Swiss is at the 200 week. So amongst all this noise, and I haven't run the interest rates. I was just doing this work this morning when the unemployment number and that stuff came out. But I am looking at this because there's a lot of mean reversion going on. And I love when markets get into mean reversion and revert to mean, because now I can put my thinking cap on. And then, it's when things get stretched so far, those are difficult markets for me because I can't determine my real risk levels. Then I'm just throwing shit against the wall to see, and I'm always getting beat up when things really get too stretched because I still like the fundamental story, but the pricing end of it doesn't match. So I run a lot more risk and I always pay for it. I know that's a big hole in my trading. When we got mean reversion going on now, and I love that.
What was platinum gold 200 week? What was underneath that? Silver?
Platinum gold. Then we had silver, copper.
That's it.
Here, let me run that right now.
That's the one that I want to look at. I want to look at all of them, but especially that.
Yeah, and then we have the others. The grain markets are still on the run. So that was the discussion I had with Rosenberg, where I, again, Yellen. So I'm on the 2 Ys, Yellen and Yuan. A lot about this world. So I got time.
Peter was great. Peter Bookfire was great yesterday on CNBC.
I didn't see him, but I talked with Pete. We email all day long. I have great respect for him. He's a clear thinker. He doesn't hide it. And he says when he's wrong, and he'll be the first to tell you that he's wrong. So that's a very important thing. So they are going to push him. They're pushing the, let's see. Well, actually, it's interesting that the 30-year is higher. The futures is higher.
Yeah, I'm not a big fan of that. All right, so what do you make of that? The 30-year and the dollar today.
You know what? If I was one of these massive shorts, I would start covering, because how much are you going to get out of this? Because they're on the same situation too. All it takes is one announcement, and they're vulnerable. And they're going to run it up, and the Fed will run it up against them. So, you might want to be, if I was in their shoes. Now, who am I to say? Just Stan Druckenmiller is one of the greatest traders in the history of modern finance. They know how to push trades, but
you mean short bonds, right? Short 30?
Yeah, they're all short.
I still have a couple left, so I'm gonna start looking to cover.
Well, yeah, but you've made a lot of money, so you know.
No, I've had them for a while, yeah.
Yeah, so it's been a good play, and it's important. And you know, you'll find what you want. We'll see this.
Before you take off, let me ask you this. So before you take off, we had talked a few weeks ago about what the capital flows will look like in the event that the Fed actually announces yield curve control. We had the dollar will rally, will be long dollar aggressively. Buy gold, and it'll be the last leg of equities up.
Yeah, I think so. I think so. And now, you know, I said to you the other day, when Zero Hedge, when were we on? When Zero Hedge came out that day and said, oh, there's going to be Twist 3.0. And I said, yeah, you know, they're the sensational, they're the National Enquirer of financial news. They like to get out there and they like to make a splash with the headlines because especially in today's world, the Reddit, I'm not the guy who started Zero Hedge, or the people who started, pretty bright, very bright. I knew that they had come out of investment banking, and then when he was outed, it's, you know, okay, that made perfect sense because he knew things that only those who worked in investment bank could possibly know. But now, you know, he throws this out, and I said to people, "Oh, did you see? I think it's bullshit." Sorry for my coarse language, because the bank stocks didn't get hit. If it's coming, any type of twist or yield curve control, the bank stocks have to correct. They've had massive run-ups.
Huge. Right?
So any market, you know, again, that's a massive run-up, and any sense of yield curve control, because they've gone up because of the steepening in a lot of people's minds, and a lot of people are looking for that. We're buying them as they kept steepening. So if I start, you know, I'm seeing a little correction over the last couple of days. Goldman is down now, but Goldman's a hedge fund. They're trying to get that Marcus off the ground. I'm not a fan of it. I don't think Goldman should be in the retail banking business. I always root against what's his name on the golf course because he wears that Marcus hat. He's a really good player, but I root against him all the time because I'm opposed to Marcus. I think that Goldman has no business because they're a giant hedge fund. They can tell me whatever they want, but they're a hedge fund.
Do you the mass exodus from Goldman of a bunch of, you know, I don't know, mass exodus, but a bunch of high level Goldman people leaving lately, is that significant in any way to you?
I don't know. I'm not privy to what is going on inside Goldman. I just look at it, and they're a hedge fund, and they have a free run because a lot of the banks, Deutsche Bank, UBS, Citibank, thank you, Patrick Cantley is absolutely right, and there's no reason for me to root against him other than he wears that Marcus hat. So that's my own biases. So, but Goldman has a free run because all those banks who tried to mimic Goldman after, especially the repeal of Glass-Steagall, which Goldman was highly responsible for, as was Citibank with Bob Rubin and people who pushed for it, Hank Paulson, but they've left the field basically to Goldman. A lot of them they couldn't make it. They took too much risk and it really cost them. And I think a lot of their bigger shareholders said, this is not banking. Yeah, it was great when we were running massive profits, but after 07, 08, when they took some massive hits, even Goldman took the hit, I think they've departed. And my favorite bank right now is UBS because they've gone back to what they do well with wealth management. And their footprint in Asia in the wealth management business is enormous. So that's my favorite. And I like them very much for that reason.
Does anybody have any last questions or follow-ups for Ira? like you talk about Lenny, I just want to end, if nobody has anything else, I just wanted to, you talk about Lenny, Lenny Feldman is and Judd always did too, was such a great mentor to so many, and I feel like he would be my kind of, like my grandfather in the lineage of my mentors, from Judd to you, Mickey Hoffman, and just so many other traders that I had the opportunity to be able to stand next to or ask questions of as you guys were walking through the halls, and to, a kid from the south side of Chicago getting to know guys like you, guys like Leo.
Hey,
And because you guys would answer, you guys would talk, you guys would, stop and I would ask you something when we're walking through the halls or on the floor.
hey, that's why you know what? I had so many people who were willing to teach. I knew about the underlying fundamentals.
Yeah.
I didn't know shit about trading. And these guys, hell, Vinny Schreiber, I can't tell you, wow, I was a young kid on the block and he would send me down because he hung out at Harry's Cafe with always 2 buckets of champagne, and he'd say, hey, go to Let 'em Eat Cake and pick up a dozen eclairs and come on back, and he would hold court, but he was always teaching. Always. He was phenomenal. There were people who were Bruce Johnson. I can't, Bruce.
Oh, yeah.
Bruce funded the arbitrage I worked for until the guys at Packers said, no, we don't. And I'll never forget the first time I wrote Bruce a fairly sizable check because I was running the arbitrage, and dropped it off to him. He says, "What's this?" It was a sizable check. I said, "That's your cut." He said, "What?" Yeah. He said, "Wow." He thought he was. And Bruce and I, to this day, carry on. Bruce taught me, phenomenal trader.
Is he still going? Still trading?
Still trading.
God, he was one of the best hog traders ever. That I remember we were going the last couple of years when I was in the hog pit. Bruce's guys were making big markets on the screen, to attract some of the oh my God, he was just. That was the first time that I had been able to watch what a great trader he was, and to be able to see it hands on.
Phenomenal trader. And let me respond to that. It is interesting. Okay, this is interesting because yesterday TLT, and I'm using the ETFs just was down more than HYG. And if you run those charts, so I'm answering your question, it's really getting to me that the high yield, that people are still chasing yield and they're bidding up really shit paper as far as I'm concerned, that has in any other normal market would be probably returning 700 or 800 basis points more than the treasuries, which is now being crushed into about 350 basis points for shit. But that's still, people are forced into a situation where they're all trying to chase yield. I think there's a lot of so-called zombie companies out there that will not make it, and people are buying it, and they're not getting rewarded. That's when capitalism gets in trouble, by the way. When you see, I'm sorry, I have to answer. When you see that money is priced, capitalism is not working. When times are good and everybody's trying to enter a business, the cost of money goes up, as it should, because everybody's trying to borrow. That's Schumpeter's famous creative destruction, by the way, because so many people enter a market because they're all chasing X amount of profit. But when yields are too low, it's not functioning right. And Wiz to say, now, Ira, I'm speaking theoretically, okay? And my whole being, okay? Write this down. You can't understand this more. And it was the name of my company. That's how long I gave it to these guys who now run a fund, who are doing very well. I don't knock on wood, but they're doing very well. And I gave them the name Praxis, which is when you combine the use of theory and practice. What may be theoretical relevant, if it's not borne out in practice, that's what I call the ivory tower. Yeah, it's great, but if it's not borne out, Now, as I've said, I'm almost done reading the biography. It's a great, at first I wasn't wild about it, but the biography is really good, of Deng Xiaoping by Ezra Vogel, who just died also. A lot of good people just died. But Deng's phrase for after Mao died and the theory of communism or socialism in China, Deng had a phrase, and I was really taken by it because it's my whole concept of being. And what Deng said is this: if I believed in getting tattoos, I would have it tattooed on me. Practice is the sole criterion of judging truth. I'm going to say it again, because this is what we strive for. Practice is the sole criterion of judging truth. It's the same way that I read the Bible. I read the Old Testament. It's all theoretical until I take what it directs me to, how to be a better person, until I put it into practice. Outside of that, it's just theory. And we're all people in theory. What do we do in practice? And that's the way I approach markets. How do I apply what I know theoretically to avail itself in the markets? And that's really, and those are, and then we apply the tools. So we have technical tools. I believe I have very strong fundamental tools, but I need to combine the fundamental and theoretical and technical tools to get the best picture to minimize my risk, because that's what it's all about. I mean, anybody could stand there and shout and will be eventually right. Anybody. And what happens is, of course, in the world of the media in which we live in, the media looks for darlings, as I call them. Greenspan. I hated CNBC when they elevated Greenspan to the maestro. It's baloney, because when you look under the hood, well, his forecasts were ridiculous. Yeah, he may have a grandiose knowledge. The Fed's forecasts are notoriously bad, but everybody looks for the shortcut. I used to hate the Chicago media, and I hated them for it, that the only black person in Chicago was Jesse Jackson, because he was safe. And it tells me how the media works. They just want to be safe. They want to be in safe hands. Well, so we'll get the story, we'll put him out there, and he uses it to promote himself. A hell of a lot more going on in the world. Do not focus on what they're trying to tell you, because it's wrong. All it is the easiest for them to portray. And I can't stand that. It's like the media started elevating that woman, Kathy Wood, dark. I go, who is, so it's a new darling. Always picking heroes. They always want to have a hero. Sorry, I'm just not there. I don't believe in it, and I'm willing to do the work to circumvent that. So that's what I say. Do your work, research it, look for it. If you're looking for the easiest way, it's not there. Yeah, it might. It's like people make their first trade and make a lot of money and think this is easy. It's a curse. But I always try to combine what I theoretically believe that. Oh, I'm just getting something on Kathy Wood right now. So Bloomberg's going to have her on this evening. Oh, Tesla's down. She's been buying. And she promotes it and people follow her. Okay, it just provides opportunity for us anyway. I'm in. I love it, because I'm going to do the work. As I always used to say, and I had people, a lot of bank traders would call me. I knew a lot of them because I was in that end of the business. So spot traders, and there were guys from Goldman who I knew pretty well who used to call me all the time because I knew them through Beitler. I would say, "Oh, these guys want to talk to you." I said, "So," and I said, "What do you want from me? You got teams of people." They said, "They don't generate any ideas, And yet, when the media goes to talk, who do they go to talk to? You have to have the provenance of something big behind you, but that's not who the best minds are out there. They're not doing the best thinking, but the media seeks heroes. I don't seek heroes. You know what?
Rick has got to, I don't know who Rick has got to talk to make peace between you and CNBC, but he's got to get you back on. The only people worth listening to are you, Rosenberg, Peter Bianco when he's on, and Art Cashin. That's it.
Well, and I love Art. And Art and I used to talk, and then he got sick for a while, and because he was a blog reader, he used to cite the blog all the time in his letters. So, and then I went to visit him. I had never met him, so he gave me a personalized tour of the history of the New York Stock Exchange, which was great. I had a very good time with him. But there was just a piece out that was published from a magazine from Austria. It's in English, an interview with Jim Grant. Jim Grant is one of my favorites.
Yes. Thank you for sending that to me.
Yeah, and you should distribute that.
I will.
He really shoots at CNBC, by the way, because he talks about the people who were sent off in the wilderness. Mark Faber, another one of my favorites.
Yeah.
Not that I always agree with him, but he's generating real thoughts, so I love him for that. So we had, and he cites them, Faber. Who else is he? And they're just persona non grata because they're not going with the flow of it. I'll tell you what, when I thought CNBC was great, Gary Kaminsky had that half hour, Chicago time, 10:30 to 11. And Kaminsky was great.
That was in the 90s.
Yeah, well, yeah. Even though in the early aughts, and he stepped for a line for them, but Gary Kaminsky didn't care because he had made enough money and he wasn't beholden to them. And they liked it. That was a great half hour because he would go after people he thought needed going after. And he wasn't afraid to say it. And he really generated some great stuff. And I built a nice relationship with him that he got me. Then him and Scaramucci licensed the rights to Wall Street Week. And I was on there a couple of times. So I had a good time when they brought that. That was a very high honor for me, which was in 2016 and 17. So it's, not that long. I was on with Gabelli because I was the macro guy. And then they had me on one time with a woman from Wall Street firm, from Neuberger Berman, because Kaminsky came out of Neuberger Berman. They were trying to promote her and they had her on with me at the same time. And Kaminsky said, that was a bad idea because, they just have a corporate line. I'm a free thinker. It doesn't make me right.
No,
but
right.
I'm gonna challenge you. Just like I challenge now, and I'm challenging Rosenberg on the inflation outlook because I believe that the Fed and all the other central banks got a free ride for 25 years, riding on the back of what China's policy was. And I believe we're at a critical juncture where China's policies are changing, and it's going to have a massive impact on what was a free ride on inflation. That's over. That's what I believe. And what's my determining factor? I'm looking at the yuan. So it's telling me that the Chinese, now if the yuan really starts to weaken, I'll say, okay, but I'm going to put my theory into practice. And my practice is the trading aspects of it. I can theoretically create all types of things, but I'll let the practice be the sole criterion of judging what is fact or not.
Ira, as we continue to seek out the understanding of the context and get a better grip of the nuance of not just the markets and everything that we're doing now, but the history of what we did or what we're doing is, as Steve pointed out earlier, and Troy Moliat also texted me the same thing, is just how grateful we are to have you as part of our group now. And as I said earlier too, how grateful I am to have had you as part of my career as a trader. But more importantly, I think to just end on this and to acknowledge the fact that that you've been instrumental in creating everything that we're doing here. Globex pushing that through. All of the work that you had done behind the scenes at the CME Group, before demutualization, after demutualization. Everything, the markets, who knows what. Oh, he left. He's about to do a great mic drop.
Turn the water off? I sure will. And what about the dogs?
I can't believe I missed this entire move. Not the entire move today. I just missed today. I got 15 points.
All right, I'll be attentive. I'm sorry, what was that last one? Okay, I'll take care of that. Sorry, man.
Oh, that's all right.
Speak to the boss.
I hear that.
Thank you. Those are good, kind words and good words. And you know what? Again, this is what it's all about. And I'm happy to, have this. Now, I'm a little stupid, but I've always been a little stupid because I should be monetizing it to a certain extent. But we've had that conversation a little bit, and it will happen. And I'm not worried about that. But this provides a real backdrop to what the floor used to be like.
Yes.
Because I would have these types of conversations and really it helps me ferret out ideas as much as anything else. People back. That's, and if you read the responses to the blog, I get a lot of pushback. And I love it because one thing that I've learned, and Deng Xiaoping and I would agree, discourse is important because that's how you get to meaningful concepts of how to act. I don't need validation. Again, the validation comes in doing it right.
Yeah, right. And that's lacking. That's sorely lacking in this world right now.
It is. Everybody wants to just be validated. That's really the problem with the entire world. It's just all about validation, So it's not that Black lives don't matter, but it just seeks validation. It's the same with it's all about validation. I don't need that validation. And I think people really suffer when they move away from legitimate discourse. It's the beauty of Jim Grant. Read his stuff. And Jim doesn't care if you agree with him. He's going to give you a historical perspective laid out. And he writes so beautifully, that makes it a double pleasure. Because it's almost like reading Buckley. Whether I agreed with Buckley, believe me, in the days that Buckley was at his, I was not agreeing with Buckley, but I appreciated how he laid out an argument, how he wrote, how beautifully he wrote and crafted the discussion. It's all part of it. Jim Grant, and you should distribute that Austrian piece, unbelievably good. Unbelievably good. And important. Everything that Jim talks about, it's important and it has true content. I mean, he writes about the 1921 depression. He's written a whole book about it, but his knowledge is so deep that it makes it a pleasure for somebody like me. I can go there and get a whole lot of information, but I think we covered a lot of ground. Good question, Steve. Really a pleasure because again, you're only as good as the questions asked you. And if I dodge them like Powell yesterday, actually, the kid Nick from Wall Street Journal was asking him good questions. He didn't want to answer them. But the interesting thing that was missing, there was no question about the supplementary leverage ratio. And it left me and a few other people I know wondering whether Powell had said to him, do not ask me about that. And don't forget, because we live in a world where, as my dear daughter Alexandra, who's I think a wonderful journalist, if you read her pieces on Bloomberg, very in-depth, but she's tenacious. She was a women's soccer player in college. She was an all-England women's rugby player. She's a tough little monkey. She's a babbler, and that's the way she approaches journalism. And as she's taught me, too many people just want access, which is why CNBC doesn't attack certain people because they know they need them. Well, you know what? That doesn't work for me. As my daughter Alexandra taught me, good journalism does this. It comforts the afflicted and afflicts the comforted. And that's how we get at things. But unfortunately, in today's world where everybody wants access, they comfort the comfortable and they don't even pay it and treat the afflicted with benign neglect. And that's the world in which we live in. And we look to it as being, a purveyor of nothing. Really. It's all, and that's the beauty of Ben Hump from Epsilon Theory and his continual hammering on about narratives. Well, one of the things we do well in this room is we craft our own narrative. Mm-hmm. We cut through the bullshit of mainstream media narratives because don't forget, that's all about commercialization. And why do they push people into the hinterlands because they're bad for advertising. You know, it's like when I'm on with Santelli, and Santelli and I were way ahead on so many areas when Rick was, but if you didn't understand it, it was just words and boring, so they have no use for it. They have no use for it, even though, you know, I said, Rick, how come we're not some of the highlights? You know, when I was on with them a week before, and then a month before that, and I said, the Swiss are going to pull the peg. And and then, you know, Sarah Eisen, well, nobody saw this. What the hell? I was on a week before. I said exactly, because you could see the way it was trading. When they're intervening, they can't lift off the floor, game over. Which will be the same that'll happen during the debt markets, by the way. We'll see it, because it has to. You can't only hide for so long and pretend for so long. But we cut through the, you know, if we do our work through our ability to analyze and then put into practice, we will cut through the BS narratives that fill the airwaves. And then if we do it, we'll do it well, and people will, of course, bottom line, it's only about the bottom line.
Always. Yes, it is. All right, Ira, thank you so very much for your time again.
Hey, you know, really, you know, Matt, you thank me, but the ability to come on and it takes me out of my own mind, and the ability to generate, you know, true discourse and some better things. Thank you.
Oh, thank you.
All right, everybody have a great week. I'm heading to Chicago, by the way. So
Ira, when you come,
this weekend, because I got to pack up the house.
you want to get together for lunch or coffee or breakfast?
Well,
or something?
you know what? I'm going downtown to see my good friend Terry, because I'm back running for the board. So if anybody owns a B2 seat,
Yeah, we'll get that out. Absolutely.
yep, please, you know, take the time. I think I'm a good addition to the board. You know my mindset. I'm a broad thinker, and I think the board needs a global macro voice, especially since Michael Spencer left, and he was the guy who founded Next that the exchange bought, but he's not on there. And him and I found great camaraderie. We actually had some interesting discussions. I'm afraid I'm really sad that I haven't carried on that relationship, because he was kind of impressed with my ability to see the world in certain ways. You know, he said, I'm not used to that here. So we had very high quality discussions.
Well,
So
let me know. I'd love to.
I will let you know, because maybe we'll do one on anyways. I mean, I'll be packing, but I'll have my laptop, which I'm on now.
I'll come up by you.
Well, whatever. Or I don't know what I'm going to be doing. I'm an indentured servant packing those boxes until otherwise known. So
I hear you.
got 37 years to, although we've done a lot of work knowing that this day was going to come. It's, you know, it's only a home because of the memories. I raised 4 kids there, had great family celebrations, Jewish holidays. You know, we had a table that sat 20 and could extend it to 40. So we were the gathering place for people who had nowhere to, you know, and those are the memories I will always hold dear. But time to move on. Time to move on.
I'm glad to be part of that table, as we all.
Yeah. We will one day have a massive celebration of sorts. And thanks for the opportunity, guys. Good luck trading. There's a lot of volatility to look at.
There is a lot to do.
Yep. Thank you.
All right. Thanks, Ira.
Bye.
I'll talk to you later. I'll see you guys all back in Zoom. I mean, Discord.